welcome to 2019. Got our first video for the year. We're just going to jump straight into it. So we've before we get started, we've cut back a bit. Basically this year, just focusing on some currency pairs. So just a bit of an explanation, I guess. A lot of people trade across the range. They trade multiple different currency pairs, like 30, 40, 50 plus. They trade all the majors, minors, all the exotics, into indices, futures, different bits and pieces. Over the 5 years that I've been trading, I've just sort of really honed it down. So you can see down here, I trade pound JPY, pound US, pound Oz, US JPY, US CAD, and I keep an eye on Bitcoin. I also keep an eye on oil and gold, but I don't trade those two products much. Although I think probably most of 2019 will be bullish gold, would be my fundamental opinion. But anyway, just a quick look. So to start this year, there's not a heap of opportunities, but there is a good opportunity on a weekly chart, I believe, on pound Oz. So we've got pound Oz here. What do we got? 77.81.4. So we've got a 4.5 pip spread. That's a weekend. That'll close up on that market open tomorrow to about 2 pips, I think. We're just going to zoom in. So, all right, let's have a quick look. Weekly chart. So this goes back 2014. Market's falling around. This is Brexit coming through here. Market has slowly been making its way up, but with the there's an announcement on the 18th of March, which is the result either way of the Brexit, whether they're out, they're in. I don't think they're going to strike too much of a deal. I think probably, and this is just a guess, I think the best anyone can do at this stage is guess, but I think they're probably going to exit the EU with not much of a deal, which will probably send the pound south. I think that'll be short the pound in the interim, so most of 2019, but I could be very wrong. There could be things working in the background. So we're just going to take a complete technical look at it. And just keep in mind, it is only the 6th of January. We've still got, what was that, 6th of Feb, 6th of March. So we've got about 10, 11 weeks until the announcement. So we've still got plenty of good opportunities in that time. All right, so just going to zoom in here. So just before we note, just this horizontal support resistance line through here. So we've got support on a monthly, broken, resistance, break, resistance, break, support, break, and it's potentially support again at the minute. It's come back, but I do want to zoom in. I want to show you what's happening. So we've got this, it is sort of a short-term uptrend in a sense, but just keep in mind it did start in September 2016. This is a weekly chart, so this is quite a bit of ground it's covered. It is 2019 now. So price has come up, made a higher high, but it's come back down here and it's made a lower low. And then last week, price really spiked and then that really cooled off again. So this nice weekly bearish pin bar. And what I like about this bearish pin bar is it's coming down. So I believe that price is coming down to here again before it'll either break this and come under. Just keep in mind we said 10 to 11 weeks to the Brexit. That's about a 10-week period down here. So I think it's probably going to be priced itself in that price comes down this way. When Brexit comes out, I don't know whether it's going to bounce. I don't know whether it's going to break. Anyone's guess is as good as anyone else's, I think. The whole thing, it's hard to say. Like I said, it's just guessing at this stage, so we'll just trade a straight technical opinion. But I do think price is going to meander down here, and I was hoping that was going to happen last week, even though price was really bullish, but it cooled off on the Friday, which got me fairly excited. So let's just take a quick look. We're just going to grab a basic Fibonacci. Just going to go fractal high to fractal low. And what we'll look at is the 50% retracement. So price has come up. It's broken to 61.8. It's tested 78.6. And it's come down. It's closed below the 50% retracement. All right, so that's box tick number one. The bearish pin bar to start. And then the test of these 3 Fibonacci levels, which are all key levels, 50%, 61.8 and 78.6, and the fact that it's closed below the 50 again. All right, so the way I enter trades on these big weekly pin bars, and I'll tell you why. I'll just drop this next Fibonacci on. So basically what I do is on the pin bar, I just drop another Fibonacci high to low. All right, and then I basically look for an entry, excuse me, at around the, just put that up in there, 50% retracement of that pin bar. Now that could be the 50%, it could be the 61.8, it could be the 78.6, but we start looking for price action on the daily, and then we start looking for price action on the H4 at this 50% level. So as an example, I'll just take that Fibonacci off for a second. If we get price action here at this level, on a H4 or daily, we will get short with that price action. If it happens at the 61.8, we get daily or H4 price action, we will get short at that level. And if it happens at the 78.6, which is also this horizontal resistance area, we will get short at that level. But I'm very keen starting at the 50%. I have done some research. If you look at all these pin bars, you've got 1, 2, 3, 4, I think there was about 11 through here over the last 3 years. Now, most of them reacted in between the 50 and the 78.6. There was no winner. There was no dominant retracement level, but certainly the 50 to 78.6 and the 61.8 are all relevant levels. Most of them were daily price action. There was a couple on H4, and some had no price action at all. Price just turned. Now, the reason price does turn at those levels is because that's where a lot of the smart money is sitting. You see a lot of retail, people sitting at home on their personal computer trading, and they're down on the H4 charts and hourly charts and 5-minute charts and 15-minute charts and all that sort of thing. And there's a lot of noise down there, and there's not a lot of clarity to be had. But a lot of the big institutional investors and the big equity firms that are trading hundreds of millions of dollars at a time are sitting at these key weekly levels. So the institutional traders will be sitting waiting here. They'll be hoping that price on Monday morning opens and meanders up, and they will probably help price meander up. They'll just be buying slowly, and they'll see this H4 daily price action. They'll help create price action, and when that happens, they will get short, and they'll get short in a big way. And that's why markets will turn on a dime in these areas. It's because that's where all the smart money is. When I say smart money, I mean big money. So even though retail traders make up about 80% of the market, they really only make up about 20% of the volume. It's the big equity firms, the big hedge funds that create 80% of the volume, and they certainly serve up their clout in these key levels. So the best you can do as a retail trader, as we all are, is not to try and change the direction of the market yourself. It's to understand where the big money is sitting, the smart money is sitting, and just to ride on their coattails. It's the only way you're going to survive in this game. So when we get in this 50% retracement of this weekly pin bar, I will be looking to get short, and I will be riding it down into this support level here, at the very least, in this horizontal potential support here, which is a little bit early, but let's just have a quick look at some numbers. So I've determined over time that I can trade with a 45 pip stop loss on pound Oz. It's got a fairly tight spread at just a couple of pips. It just depends which broker you're with, but I've got a fairly good account. I just pay a commission on a trade, and I don't pay much spread. The spreads are very tight. You guys can trade with who you like. I won't tell you who I trade with, I guess, at this stage. Later in the journey, we can start talking about brokers and who's better, but it'll still just be my opinion. But we'll just keep that to ourselves at this stage. But so 45 pips with a nice tight spread. So if I get price action at this 50%, so we got 81.44. So we had 45 pips to that. Roughly, we're looking at 81.88. And then we're chasing down here at the very least. What's that? 860 pips. So we got 860 divided by 45. So we got 19 to 1. So if you've been trading for 3 weeks, you probably think that's not exciting. If you've been trading for 5 years, like 19 to 1 is unbelievable. Unbelievable. I don't think I've ever actually achieved that result. I think the best I've got is about 13.6. That was in 2018. So if I could knock off a 19.1 risk to reward, I'd be very, very happy. So multiply that out by whatever amount you like to risk on a trade. Let's assume it's $5,000. So multiply that out by $5,000. And you look at a $95,000 return on that trade. If that takes 10 weeks to play out, divide that by the 10 weeks, you're looking at $9.5 grand a week. It's not a bad way to make an income. You can drop the kids off to school in the morning, come home, have your coffee, do a bit of technical analysis, read a few books, and go and pick the kids up in the afternoon. All right, guys, so we're just going to wrap it up there for the week. That's the only trade that I'll be looking at this week. I am keen on pound JPY and pound US, also US CAD, but not this week, probably in the next 4 to 5 weeks. There's some support resistance coming up on weekly timeframes, but not just yet. So I am going to take off for now, and I'm going to talk to you again next Sunday. I wish you all the best. I hope you get an entry. I hope I get an entry on this trade, and then we'll ride it out and see how we go. All right, guys, chat next week. Bye.